Now, the reason I want to show you the power of diversification is, and I've seen a lot of videos out there where they're like, oh, retire on Tesla, that Tesla is supposed to grow by 10, 15, 20%. So if you just buy only Tesla stock and then you'll be able to retire in a few years. Well, let's go ahead and let's take a look at that. Let's see how that's actually doing. Hi, it's Griggs of the Sitting Wisdom. Today we answer the question, why is diversification important for your retirement? Today, I'm going to go over 4 different portfolio designs. Each of them are relatively consistent, and consistency is the name of the game when it comes to your retirement. Because of the fear that many of us have about running out of money in retirement, it causes us to make one of 2 mistakes. One is we're too conservative with our investments. We are very nervous about losing our money, and as a result, we want to choose something that is almost guaranteed. Now, for many people that I work with, they end up either wanting to focus on their pensions with a guaranteed return. Sometimes we look at annuities where, again, we're trying to figure out how to have a consistent guaranteed income. So it's just one less thing we have to worry about in retirement. The issue, or at least I would say the small risk that we may run into, is if we're too conservative, if we're too focused on finding that guarantee, what we may be doing is leaving a lot of money on the table. The reality is, these 4 portfolios I'm going to show you, they're going to get you a pretty good return on a relatively consistent basis. Now, if you said to me, Drake, can you guarantee me a return? I would say, well, no, I can't guarantee a return. But what I can say is the people who do guarantee returns, let's say they guarantee a 1.5%, a 2%, I see them kind of fluctuating right around there. Well, when we take a step back and we ask, how can they be so confident that they can guarantee a 1.5, a 2% return? And the answer is naturally because they plan on making more than that. They have to make more than that to be able to pay you a guaranteed 2%. But Dre, what happens if they don't make that 2%? Well, that probably will happen. There's going to be years that whatever their investments are going to lose money. That's just kind of the way the stock market works. But because they made so much money on the better years, paying that 1.5, 2% guarantee on a year that they lose money, they'll still be well off. They'll still be better off based on the amount of returns that they received on the good years. So on an average good year, you could be looking to get anywhere from 8 to 10%, right? If you're just invested regularly in the stock market. If you are someone who's only going to get 1.5, 2% of that, that gives me the ability to put that money aside for that rainy day. Now, normally when we're about to retire, we're not looking for the 8 to 10%. But what I do want to caution you, and at least I'm hoping to show you with this video and these 4 portfolios and then a couple of other examples, if you're focused too much on conserving your wealth, you might actually not be making return enough to keep up with inflation. For example, when someone gives me a guaranteed 1.5, 2%, well, I know inflation is about 3%. So that 1.5, 2% isn't good enough for me. I at a minimum would like my money. Let's say everything worked out perfectly. I paid off all my debt. I have all the money that I need in my account, and I just need to make sure that I don't run out of money. If every other box is checked off, everything is good to go, then I would say at a minimum, I do want to get at least a 3% return so that way I can keep up with the average inflation. So the plan then is to go over 4 portfolios that you could use in retirement that are relatively consistent and will give you the comfort that you need to be able to grow your money to keep up with inflation and to preserve your capital so that way you're not worried about running out of money in retirement. So the first one is called a permanent portfolio, and it's just as it sounds, right? This is the idea that I'm going to have this portfolio built and it's always going to work. I'm just going to maintain these allocations and I'm not going to change it at all. And so the way it works is you're invested in 4 different asset classes. You put 25% of your money in the total stock market. You put 25% of your money in long-term bonds. You put 25% of your money in cash, 25% of your money in gold. So this was created by Harry Brown back in the late 90s, and it's actually in his book, Fail Safe Investing. And the idea behind the permanent portfolio is during times of economic prosperity, then we should probably be investing in the stock market. During times of a recession, we should probably have our money in cash. During times of high inflation, you'd probably want to have your money in gold. And during times of deflation, you want to have your money in long-term treasuries. By having an allocation that works in every single economic climate, that means you should always have some part of your portfolio performing very well. And it also naturally means that you should have some part of your portfolio that is not performing very well, but it should be able to maintain a consistent return where you're at least going to keep up with inflation and you're not worried about running out of money because you have a portion of your portfolio that will always be performing very well in every single economic climate. Now, if you wanted to create the permanent portfolio on your own, you would be invested in BIL, SCHQ, ITOT, and IAUM. And the total expense ratio for this portfolio is just 0.07. Now, naturally, you could choose from a variety of different ETFs and mutual funds to be able to create this portfolio. I just gave you four quick examples that you could look into using, and they have a relatively low expense fee. Now, this portfolio on average from 1970 to 2023 has returned 4.7%. So we're able to keep up with inflation. 24% of the time, this portfolio has lost money. 76% of the time, this portfolio has made money. You can see within the 24% of the time that this portfolio lost money from 1970 to 2023, that the loss was somewhere between 0 to minus 10%. So 20% of the time you lost 0 to minus 10%. And then just 4% of the time, this portfolio lost more than 10%, but never exceeding 20%. And so when you look from 1970 to 2023, that will be when we left the gold standard, the dot-com boom, Y2K, 9/11, Great Recession, COVID, all of that is in there. And we're saying that only 4% of the time we lost more than 10%. And you can also see that the permanent portfolio exceeded a 10% return almost 20% of the time as well. So you can see that this is a relatively safe, conservative approach, but you are still exceeding inflation and you have a relatively decent return. Where if you're someone who was thinking about using the 4% withdrawal strategy, you could use that with this particular portfolio design because on average you are meeting or exceeding that 4% return. The next portfolio design that we're going to look at is actually one that I like a lot. It's called the Golden Butterfly Portfolio. Now, you guys have probably heard me talk about this one at some particular point in time, but it's basically broken up into five categories. You have 20% of your portfolio in total stock market. You have 20% of your portfolio in small cap value. You have 20% of your portfolio in long-term bonds, 20% in short-term bonds, and 20% in gold. So you're still keeping in mind that the idea is for us to have a portion of our portfolio that'll perform well in every economic climate. One thing that the Golden Butterfly portfolio design achieves that the permanent portfolio doesn't is you have 20% of your money that is sitting in small cap value. And small caps, if you don't know, those are normally going to be companies somewhere under $2 billion in value, probably over $100 million. So we're talking about risking money in companies that aren't generating any revenue, but we are finding companies that haven't become the Amazons of today, the companies that are on their way possibly to becoming one. These oftentimes are very regionally focused companies where they're very successful in a particular region, not necessarily global or even national, but they are able to generate hundreds of millions, if not billions of dollars every single year in revenue. And by us focusing in particular on value stocks, what that means is we're not trying to find a growth company, a company that has not actually generated any of the revenue. By focusing on value stocks, what we're saying is these companies are great companies today. And we are investing in them because we believe that they are at a great price. Based on the earnings per share, profits, and a variety of other factors, we can say that this is a good company today. And as a result, we are now comfortable investing in these companies. And even though they are smaller companies, which means they're a little bit more volatile than large companies, if there is a recession, usually the smaller companies are the ones that are capital intensive. They're reinvesting the money. They normally need loans from banks. And so sometimes that money dries up and it becomes difficult for them. And that is often the reason why a lot of people like to focus on large cap investments. But if you're someone who's looking for a slightly higher return and you don't want a lot of your money allocated towards safe investments, then this gives you the nice mixture of all things. If this was a portfolio you wanted to achieve on your own, I'll give you a few examples of some stocks that you could use. You could use the ITOT, VBR, SCHQ, SCHO, IAUM, and the average and the total expense ratio for this portfolio will be 0.05%. Now, when it comes to your return, you can actually see that it slightly outperforms the permanent portfolio, but you are averaging a 6% return with a 19% loss frequency rate, which is better than the permanent portfolio. About 16 to 17% of those loss years where we lost 19% of the time, well, that'll be less than 10%. About 16 to 17% of the time, you're going to lose less than 10% of your portfolio. And then that last 2 to 3% of your losses, you could be anywhere from 10 to 20% as far as the loss would be concerned. And when it comes to the gains, you can see about 55% of the time you're going to have that 6% return. You can see about 23% of the time you can expect to have a 10 to 20% return. And then about 5% of the time you can expect to have a 20 to 30% return. And again, this is one of those portfolio designs where we're outpacing inflation. We're still making more of the 4%. So we wanted to do the 4% withdrawal strategy. We could. Technically, you can push it up to 5 or 6% because that's normally what we get on average. But if you maintain that 4% withdrawal strategy, then it allows your money to continue growing. So as a result, over the years, you're taking that same 4% out, but as you have more money, your 4% becomes a larger amount. So in the end, you're actually going to be able to increase how much income you receive each month, which is going to be nice because you're looking to keep up with inflation anyways. Next, we have the All Seasons portfolio. This was made famous by Ray Dalio. It's a version of what he uses in his own hedge fund. Now, naturally, we don't have the same access to information, people, and capital, but Ray Dalio is giving us a blueprint that we could use. And the way his works is this 30% of the total stock market, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in commodities, and 7.5% in gold. So you can see with this portfolio, Ray Dalio was trying to do the exact same thing as you've seen with the other two portfolios, which is having a portion of my investments that will perform well in every economic climate. If I have that in my portfolio, then that's going to mitigate the opportunity for me to lose 30, 40, 50% because I know that a portion of my portfolio is going to be going gangbusters, that there will be a portion that is going to be going up 20, 30% to offset my portfolio that's going down 10, 15, 20%. Which is why you see that even though those portfolios have years that they're losing money, they're not losing a lot of money. They're not losing as much money as someone who is focused on any particular sector of the stock market where that sector doesn't perform well in one given year. You could end up losing 20, 30, 40, 50% easily. Now, granted, you could gain 20, 30, 40, 50% as well, but by having these allocations, you're able to focus on what's most important. The most important thing in your retirement is making sure that you enjoy yourself, that you're able to achieve your goals, and that you don't have to worry about the money. If we can help you achieve your goals and keep you from worrying about running out of money, I am confident that you'll be very excited about retirement, regardless of the fact that a portion of your portfolio is not going to be performing well at any given time, and a portion is going to be performing very well at any given time. So if you wanted to build this portfolio, I'm just going to give you a few ETFs that you could use that have very low expense ratios. Again, you don't have to use these, but these are just to get you started on your search. So we would have ITOT, SCHQ, SCHR, GSP, IAUM. And this total expense ratio will be 0.08. So this portfolio, you can see it averages about 5.2%. That's what the return is on average. 26% of the time you will have lost money from 1970 to 2023. Of those times that you lose money, about 22 of the 26% of the time, it'll be less than 10%. And then you would have about 1% of the time that you would have lost 10 to 20%, and about 1% of the time you would have lost 20 to 30%. And then on the positive in this portfolio, 46% of the time would have generated you 5.2%. And then you can see about 21% of the time this portfolio would have gotten you 10 to 20%. And then you can see that this portfolio about 6% of the time would have generated 20 to 30% as far as your returns. So you can see two things that you notice here. One is you have a lot more upside. And naturally, if you're going to start exploring some volatile asset classes like commodities, that does open you up for a lot more gains where you see that 6% of the time we had 20 to 30% as a return. And you can also see that 21% of the time we even have more than 10% as our return. But because commodities are so volatile, we now open ourselves up to about 1 to 2% of the time we could lose up to 30%, and about 1 to 2% of the time we could lose 10 to 20%. So you can see that there is that trade-off, and you find that that's often what ends up happening. Most of the time, for us to be able to have access to the high returns, we probably have to open ourselves up a little bit to a little bit more volatility and a little bit more of a possibility of losing more money. Now, the good news is because we balance this portfolio design, or at least Ray balanced this portfolio design, you're really only opening yourself up to an additional 2 to 4% chance of losing more than 10% for you to be able to have another 30% chance of gaining more than 10%. Those ratios often could work for people, but it naturally depends on your overall risk tolerance, your overall retirement plan design, and whether it makes sense for you. The good news is, on average, you'll have about 5.2%. So again, we're outpacing inflation. Again, we're able to maintain that 4% withdrawal strategy. And again, our portfolio is still growing by 1% on average, which means we have more money and less worry in retirement. Our fourth and final portfolio that we'll talk about today is called the 712 portfolio. And this portfolio was created by Craig Israelson and is basically an asset-based approach where you have a little bit of money in a bunch of different asset classes where we're able to maintain a certain consistent return without us opening ourselves up to a bunch of losses. So in this portfolio, you have about 12.5% in large cap blend. When you hear the word blend, what we're saying is normally you're either going to be a growth investor or a value investor. And that's normally going to be the two ways that you decide how you want to have your investment approach. If you have a blend, that means you have a little bit of growth and a little bit of value inside of that particular portfolio. And so we're going to be 12.5% large cap blend, 12.5% small cap blend, 8.3% international stocks, 8.3% emerging markets, 17% intermediate bonds, 8.3% international bonds, 8.3% cash, 16.6% commodities, 8.3% REITs, which is real estate investment trust. So you can see that this particular design has opened us up to a little bit more volatility. And you can see that we're in small caps, we're international, we're in emerging. We also have commodities. These are highly volatile stocks. Now, depending on how we look at our overall portfolio, we may be able to offset some of these, but it is something that you want to keep in mind, especially if you're someone who doesn't have the risk appetite for a little bit of market volatility. And you'll see that we worked our way up on each of these portfolios. We went from relatively safe and consistent to a little bit more volatile and consistent, but we were able to maintain consistent where you don't have to be worrying about your money every single day, checking the stock market, making trades and trying to figure all this out. That's not the idea in retirement. The idea is that my money is growing. I'm able to focus on having fun. I'm able to focus on living my life, and I don't have to worry about this other stuff. And if you wanted to build this portfolio, this would be a 0.19 expense ratio. And instead of me reading off these 9 ETFs and sounding like an alphabet soup, I'm just going to place them on the screen. You can pause the video and take a snapshot of it for yourself if you want to. And you can see that this portfolio will get you about 5.4% on average. That is your average return that you can expect. 26% of the time, you can expect to lose money from 1970 to 2023. Of that, close to 18% of the time, you can expect to lose 10% or less. 5% of the time, you can expect to lose 10 to 20%. And then about 2% of the time, you can expect to lose 20 to 30%. Now, when it comes to you opening yourself up for the gains, you can see that yes, 42% of the time you will have that 5.4% we mentioned, and then 26% of the time you expect to have a return of 10 to 20%, and about 4% of the time you can expect to have a return from 20 to 30%. And so you can see that even though we open ourselves up to a little more volatility by investing in the emerging markets and international markets, and the reason is pretty straightforward. Their courts are different, their economies are different, they are more influenced by economic environments and climates. Sometimes our governments aren't the most stable, especially when we're talking about emerging markets. You can look at the things going on in Israel and the Red Sea. You can look at Ukraine and Russia, where when you start opening yourself up to emerging markets and international markets, you don't really know what's going to happen on any given day. And because you're taking on a little more risk and a little more volatility, you open yourself up to a much higher percentage of a return. You'll notice that the average return has been slowly decreasing with each of these, where this one, it's only about 42% of the time. But on the first ones, that number was way over 50%. And so you can see that we're slowly getting more volatile. That means that the number is going to fluctuate a little bit more and is not necessarily something that we can pin down. This, for most people, when they're in retirement, is probably not going to be the allocation that you want to use. It is one that opens you up to a higher upside, but again, it also opens you up to a little bit of a lower downside. But the trade off is definitely there for those who are more comfortable with it. And what I mean is, you have the ability to make more than 10%, 10 to 30% of a return, at least when you look at the numbers historically, almost 30% of the time. So yeah, 40% of the time we're going to be on that average 5%, but 30% of the time you open yourself up to be able to make more than 10%, 10 to 30%. That is pretty nice for someone who's able to stomach that. And then what did it cost us? Well, it only really cost us a 26% chance of losing money. But of that, we really only opened ourselves up to a 6% chance of losing more than 10%, which for the right situation is a pretty reasonable trade-off. So you can see based on these four portfolios, depending on your overall risk tolerance, how long you have to retirement, that they are relatively consistent. You're able to outpace inflation, and you're able to make more than that 4%, where you can follow the 4% rule if that's what you want to do, and you're able to still grow your money, which will give you the ability to steadily increase your income even as you are retired. Now, the reason I want to show you the power of diversification is, and I've seen a lot of videos out there where they're like, oh, retire on Tesla, that Tesla is supposed to grow by 10, 15, 20%. So if you just buy only Tesla stock and then you'll be able to retire in a few years. Well, let's go ahead and let's take a look at that. Let's see how that's actually doing. So Tesla right now, if you look at the past 5 years, it's at $191.97. That's about an 880% increase, which is really good. If you bought Tesla over 5 years, and you're able to keep investing in it, then you were like, hey, look, this worked out really well for me. When we first started on March 1st, 2009, Tesla was about $19.65. And then when you look at it now, it's at $191.97, right? That's obviously a great approach. The issue is, and I'll share the graph with you, whenever you're invested in one single stock, when that market goes up and down, that stock can lose a lot of value. And so in this one, we're going to talk about 5 different times that happened to Tesla. So you can see on July 25th, 2019, the Tesla stocks plummet after Elon Musk announces the company's tech boss is leaving. You can then see that it then starts steadily increasing again. But then you can see on September 8th, 2020, it says Tesla shares suffered their worst day ever. They lost 21% in value in one day. I don't know how many people were able to maintain their investments when they watched the stock lose 20% in value. But if you did, kudos to you because it did go up. And then you can fast forward all the way to 2022, where it says Tesla shares skyrocketed more than $140 per share on good news about deliveries. So this is what we call event trading. This is not normally a long-term investment strategy, but a short-term investment strategy. It just means that on any given day, there may be amazing stock market news, and then the stock goes up, up, up. Just like it could have been bad news, the stock goes down, down, down. So earnings reports, things like that are normally good times to be able to do event trading. But again, that's not what we would be doing when we're talking about retirement planning. And so you can see on that day, the stock went up 14%, which is obviously really good. At this particular time, the stock now is worth $352.67. That would be phenomenal. If you were someone who bought it at $20 and that was worth $350, you are saying, I am the smartest person in the world. And the truth is, the numbers work out. You are one of the smartest people in the world. This would have been gangbusters. But as you know, it's at $191 right now. So what happened to the rest of it? It was at $352 in 2022. We're just at the beginning of 2024. Where did all the value go? And you'll see on January 3rd, 2023, Tesla stocks fell 15% after the delivery shortfall. So we gained all that value because of the expected deliveries. And then when all the deliveries didn't come through, we lost a lot of that value. So that's what ended up happening. And you can see that stock went up to $352. And you can see a year later, that stock dropped to $113. That the stock lost close to 2/3 of its value. And you can see why I told you event investing is considered a short-term strategy, because if it's based on an event, and it's not really the value of the company, but based on an expected value of the company because of some future event that's going to happen, then you'll see that you'll end up losing the value as quickly as you gain the value. So you went from 352 to 113. So the question is, how many of us would have been able to say, you know what, I'm going to ride this wave. Yes, I lost $200, but I believe in Tesla. This is going to pay for my whole retirement. I'm going to pick this one stock. They told me on YouTube that this is the great stock. I feel good. I don't know how many of us would have been able to do that. That's a really rough ride. And then you can see just about a month ago, January 25th, 2024, that Tesla shares plunged to wipe out $73 billion in market value after a really bad earnings call. So again, this is event trading. It's not that the company is necessarily doing a whole lot. It's a very volatile stock because a lot of people are speculating, which is a very fancy way of saying they're gambling. They're saying, oh, Tesla got a whole bunch of deliveries. That means they're going to have a bunch of money. I'm going to go buy it now before they do all the deliveries. And then naturally, once you get the earnings report where they're like, hey, all those deliveries that we said we are going to do, yeah, most of them didn't happen. Well, a lot of people are going to sell that stock because if they bought that stock at $300 or $200, that's a really rough time for them to hear that they did not meet those earnings. And so the stock loses its value. And that's why I caution my retirement investors to diversify your assets. Well, sure, we can open ourselves up to a significant gain. There's no doubt about it. You could have gained 888% if you invested in Tesla 5 years ago and held it this entire time. But it's also true that the company has lost almost $100 billion in value since then. And it's equally true that your investment portfolio was very volatile and you're actually down significantly if you entered in 2022 versus if you entered at 2019. It's all about when we enter these companies, and sometimes we don't really know. How would someone know that they entered Tesla at the point in time that it would have been growing by 300, 400, 500% versus when it was losing value by 1, 200, 300%? Which is why for most of you, when it comes to investing for retirement, it makes sense to have a diversified and consistent approach so that you're able to have a consistent return where you limit the volatility so you can actually plan around these investments for your retirement. If you are someone who is planning on retiring in the next 5 years and want help feeling happy and not worried about it, don't worry, I got you. Go to obsidianwisdom.com to learn more. Until next time, stay safe and enjoy life.